Hi everyone, it's Grace. Welcome back to my channel. Today I will open up an important topic about housing affordability in 2022 since many of you requested it. During such a strange time where housing is becoming more and more unaffordable, is it still realistic to buy a home with an affordable price? We have gone through many data in the past, including where are Wall Street institutional investors controlling price and rent, and which cities have the most investors, and so on. So you need to know that not all the housing markets are experiencing the same boom and bust cycle. The growth rate varies a lot according to different markets. So today we're going to take a look at the hidden gems and underrated markets where housing is still affordable, especially for first-time buyers. Before we begin, remember to subscribe to my channel and click on the bell button so you get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. First of all, from a macro level, it's important to understand the current status of the housing market. The other day, I was looking at FHFA's Housing Price Index, CoreLogic's Case-Shiller trend, as well as Goldman Sachs' housing forecast, and I noticed something interesting. When it comes down to forecasts, there's always a level of uncertainty. While they provide different forecasting numbers, when I look at them in detail, they're actually not that different from each other. The blue line is the Case-Shiller index and the red bars is the HPI. By the end of 2022, Case-Shiller forecast year-over-year growth of 2.4%, while HPI is at 7.4%. And the pattern of HPI and Case-Shiller index is the same. From now through the end of 2022, the housing price growth will slow down sharply, so it's shaped like a rocket. Note that this is the price growth trend, not the price trend, so it's not the crash line. When we translate a graphic for growth into a graphic for price, it looks something like this. Now let's take a look at the number by Goldman Sachs. It forecasts that the year-over-year growth is going to be 16%, which is quite different from HPI and Case-Shiller index. But its growth trend is also shaped like a rocket. So the only difference is that Goldman Sachs forecasts that the timeline will be delayed a year further to the end of 2023 instead of 2022. And Goldman Sachs' model is actually built on a foundation of the Case-Shiller index. This means that all three sources agree that there will be a major crash on the housing market, but disagree on the exact crash point. The Case-Shiller index suggests the earliest from the end of 2022 to early 2023. FHFA's HPI suggests later from 23 to 24, while Goldman Sachs suggests the latest from 24 to 25. So what does it mean? It means that we're going to experience a period of horizontal trend, and a housing price curve looks something like this. Personally, I don't think the horizontal period is going to last very long. First of all, because of high inflation, the federal rate hike is probably going to happen sometime next year. And second, the market needs to go up and down in order for more opportunities for asset investment. If it stays high for too long, there's really not that many opportunities to either invest or short the market. You know what I mean? So based off the three sources we just discussed, while the crash point is uncertain, the housing market will probably stay at a high level for at least a year. So back to today's topic, if for one reason or another, you decide to take out a lot of mortgage to buy a home in one of the hot real estate markets, by all means do so. But for first-time buyers, if you're tired of waiting, there are still a lot of strategies we can use. This is a time where financial reasons should probably be prioritized over other reasons. You may not have everything you're looking for in a neighborhood, but by just adding a little flexibility in your strategy, you'll be more successful in the long run. So let's take a look at the map that shows the pattern of the median price for single-family homes. For the purpose of today's discussion, I will break down the markets into 5 price tiers. Red is 500K and up. Orange is from 400K to 500K. Light green is from 300K to 400K. Middle green is from 200K to 300K. And dark green is below 200K. And this is the price in third quarter of 2021. The idea of affordability really depends on your household income and financial structure. So I want to show you a general idea of affordability according to the pattern in this map. The first strategy is to separate your self-living home from your future investment home when you get to that point. Where you live doesn't necessarily have to be where you invest because the US housing market is opportunistic with a lot of volatility. So one way to approach affordability is to buy a home in a proximity of an overpriced city. For instance, instead of buying in Phoenix, you can buy in Tucson, which is about 100K less with about the same growth rate. And instead of buying in San Jose, you can buy in Fresno, whose price point is massively different with the same growth rate. And instead of buying in Durham, you can buy in Greensboro. And the logic is the same. This approach allows you to buy in the same state with similar growth in home equity, so your living environment wouldn't be that different from what you originally want. Since the first home that you buy will probably not be your last one, your household balance sheet will be a lot healthier by adopting a little flexibility. And if you're very flexible with location and don't necessarily have to stick with one state, you have plenty of choices. So in the next part, I'm going to sort the homes according to a maximum price and a minimum year-over-year growth rate. The first criteria will be a price point of less than $350K and above 20% growth. Here's an important point when choosing these homes. Since the inflation is continuously growing, in November it went up to 6.8%. So we can pretty much say that if the Fed does not close up the time to increase the federal funds rate, the inflation will probably go up to, say, 10% next year. So you need to look at the homes that outpace the growth of inflation but still give you some leeway to build equity. So the homes under $350K with a minimum growth rate of 20% look something like this. The yellower the color, the higher the growth rate, and the more purple, the lower the growth rate. And I'll pull up the bar chart alongside the map for you to see. So in terms of year-over-year growth, from largest to smallest is Ocala. Its growth rate is very good at close to 30% with a lower investment threshold at $240K, followed by Punta Gorda with a growth rate of 27.5% at $325K. Then Sebastian Vero Beach at 25.7% at $330K. Port St. Lucie at 24.9% at $343K. Tucson at 24.2% with $338K. Tampa, St. Petersburg, Clearwater at 21.8% at $341K. Knoxville at 21.7% at $290K. Buffalo, Cheektowaga, Niagara Falls at 21.5% and $232K. Myrtle Beach, Conway, North Myrtle Beach at 21.4% and $308K. Sherman Denison at 21.2% and $255K. Lakeland, Winter Haven at 21% and $280K. Palm Bay, Melbourne, Titusville at 21% and $320K. Binghamton at 20% and $160K. Appleton at 20% and $253K. Daytona Beach, Ormond Beach at 20% and $300K. You can choose to buy in these areas and stay away from the competition from both individual and institutional investors and still grow your equity by structuring a proper down payment. Now, if you want to be more aggressive with your budget and further squeeze it, let's take a look at the homes under $250K but still with a price increase above 15%. Ocala makes to the top of the list again at 30% year-over-year growth and $240K, followed by Buffalo, Cheektowaga, Niagara Falls at 21.5% and $232K. Binghamton at 20% growth at $160K. Mobile at 17.7% at $203K. South Bend, Mishawaka at 17.6% growth at $187K. Decatur at 17.4% and $219K. Elmira at 17% at $148K. Bloomington at 16.7% at $199K. Fayetteville at 15.7% at $196K. Rochester at 15.7% and $206K. Springfield at 15% and $204K. Glens Falls at 15% and $240K. Another thing I want to mention is that we often say that real estate is the most inflation-hedged asset. But depending on where the property is located, not all the areas are hedged against inflation. For instance, some of the cities with negative growth rate and less than 6.8% growth rate lose purchasing value compared to the current inflation rate. In the next part, I want to show you the cities that offer people money to move to. If a city offers you money to buy a house, would you move there? That's a great question. Just by looking at a subsidy amount, it's probably hard to make a decision. But by just looking at the data a little bit more closely, you'll be able to tell. So that's exactly what we're going to do. So we're going to combine price, growth rate, as well as the housing subsidy to another approach of affordability. So these cities provide some kind of subsidy for people to pay towards the down payment, closing costs, or rent if you're just temporarily relocating. Now, some of the year-over-year growth is missing from today's data, but you'll still be able to find it on the internet. From the largest subsidy to the smallest, the first one is Morgantown from West Virginia, offering $20,000 with a median house price of $230K, followed by Topeka, Kansas, offering $15,000 at a median price of $173K and a year-over-year growth of 14.6%. And Augusta in Maine also offers $15,000 with a median price of $225K. Newton, Iowa offers $12,500 with a median price of $142K. Tulsa, Oklahoma offers $10,000 at a median price of $200K and a year-over-year growth of 11.4%. Shoals, Alabama offers $10,000 with a median price of $210K. New Haven, Connecticut offers $10,000 with a median price of $314K and a year-over-year growth of 12.3%. Britt, Iowa offers $10,000 with a median price of $93K. In addition, you also get a free lot. Ontario, Oregon offers $10,000 at a median price of $200K. Here's an interesting finding. Ontario is only 60 miles to the northwest of Boise City, which has quickly become one of the newest unaffordable cities since the pandemic. So instead of moving to Boise City, you can move to Ontario, and you will also get paid to move there. So why not? And this is followed by Tucson, Arizona, which offers $7,500 with a median price of $340K and a year-over-year growth of 24.2%. And Baltimore, Maryland offers $5,000 with a median price of $370K and a year-over-year growth of 8.3%. Followed by Juneau, Alaska, which offers $3,000 with a median price of $433K. Followed by Honolulu, Hawaii, which offers $2,500 with a median price of $800K and a 25% year-over-year growth. Although the median price for these two cities are probably too high compared to other cities. The last city is Savannah, Georgia, offering $2,000 with a median price of $230K. So today, we use different approaches to see the cities where homes are a little bit more affordable. And I will talk about the affordability issue from a financial perspective in another video. As always, thank you very much for watching, and I'll see you on the next one.